all of those things will generally accelerate institutional adoption. Every single month that goes by, there are more large institutions that come out in favor of digital assets and Bitcoin in particular. And every single time one of them announces that catalyzes another to consider doing the same.
Hello everyone, this is BTC Insight and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
For more than a decade, Bitcoin's price movements were dominated by the halving cycle. Every 4 years, the new supply of Bitcoin mined per block would cut in half, and historically this supply shock triggered a bull market. But according to Michael Saylor, this era is largely over. Why? Because Bitcoin has simply outgrown the halving's influence. Saylor explains that in the early years, the halving removed a meaningful amount of Bitcoin from circulation, enough to significantly affect price. But today?
The real story in 26 is banker acceptance of Bitcoin, willingness to custody it, trade it, and extend credit against it. And that should catapult the asset class to new levels.
And this week, Bitwise CEO Hunter Horsley argued that the 4-year crypto cycle is over. And Fundstrat's Tom Lee made the same argument, saying that the classic 4-year Bitcoin cycle is dead. What is your reaction to that? Do you agree?
Yeah, I think that the 4-year cycles are based on the Bitcoin halving, and the Bitcoin halving was really important for the first 12 years of the asset because we were cutting, the amount of Bitcoin that was being cut from the supply was very material, relative to the demand in the market. But right now you're seeing days when Bitcoin trades $50 billion or $100 billion in a single day. The total amount of the halving in the next halving is going to be 225 Bitcoin. So 225 Bitcoin times even 100,000 of coins, it's $20 million a day is the impact of the halving. And so $20 million isn't the first order impact on a $50 billion a day liquidity. It's not even a second order impact. It's probably a third order issue. The primary drivers of Bitcoin right now are the structural developments in the market. For example, if the banks extend $50 billion worth of credit, right, that dwarfs 20 million a day in the halving. And then when the SEC loosened the restrictions on derivatives trading on IBIT, the open interest in IBIT went from 10 billion to 50 billion in a few weeks. So you're talking about tens of billions of dollars of demand for the asset based upon the embrace of the traditional finance establishment. And so the asset class is being driven by the structure of support in the banking industry and in finance, and a few regulatory changes that are actually enhancing that support for the asset. Generally, I'm a big proponent of any company holding Bitcoin as digital capital on its balance sheet. I think that's good for the company, and that's good for Bitcoin, that's good for the crypto economy. Our business has evolved from a company that simply owns Bitcoin to a company that issues digital credit against the underlying Bitcoin. So today, we're the largest issuer of digital credit in the world. If thousands or tens of thousands of other companies buy Bitcoin, that will be good for Bitcoin and good for our business, so it's helpful. Out of those 250 crypto asset companies or crypto treasury companies, only a couple are in the business of issuing digital credit. Examples would be Strive, that issued a treasury credit instrument about a month ago, and then Metaplanet, the biggest Bitcoin holder in Japan, that actually just issued their first digital credit instrument. So there's 3 of us that are in the digital credit market. There's probably 200 to 300 that are holders of crypto assets. It's all good for the crypto economy. They'll all benefit. But the exciting thing in the market right now is digital credit. Before November of last year, before the red sweep, there was a lot of uncertainty over the asset class. And so I think a lot of publicly traded companies were afraid to go into space. We have a very supportive administration. The president has designated Bitcoin as digital gold. The Secretary of the Treasury has said we want to be the crypto capital of the world. Donald Trump said we want to be a Bitcoin superpower. So we're the first year of institutional adoption. And in 2025, you got the support of the SEC, the support of the CFTC, the support of the Secretary of the Treasury, the support of the President of the United States. And so normally public companies are very risk averse. And with all of those supportive moves by the administration, combined with the accounting profession rolling out fair value accounting, which was a very big deal. Fair value accounting means that when you generate gains, you're allowed to mark them up on your balance sheet. And before that point, you could only take losses. You could never take gains. So the accounting was reformed, and the regulators began supporting the asset in the year 2025. And I think that once those two things happened, it became pretty clear that it gave a structural competitive advantage to a public company to have Bitcoin on their balance sheet, because Bitcoin has been growing 50% a year for the past 5 years. And so all things considered, if you're buying Bitcoin, you're buying the world's dominant digital monetary network growing 50% a year. And the alternative would be to hold something growing 5% a year.
One of the most fascinating parts of Saylor's thesis is how MicroStrategy itself has evolved. It started as the largest corporate holder of Bitcoin. Today, Saylor explains, the company has transformed into the world's leading issuer of digital credit backed by Bitcoin. MicroStrategy has already issued around $8 billion in public digital credit instruments, such as STRC and STRF, and Saylor expects that to scale from billions to tens of billions.
Generally, public companies will start to buy more digital assets and hold more digital assets on their balance sheet. And I think that Bitcoin adoption is going to spread, and that will be good for Bitcoin, and that will be good for those companies. I think the real story going forward is going to be digital credit. If you think about the perfect product is a bank account that pays you 10% when the money market's offering you 4%. And so if you can offer people 600 to 800 basis points of additional yield over the risk-free rate, whether it's in the euro, the yen, or the dollar, then everybody's reaction is, yeah, I want that. What's the catch? And so I think that the real interesting idea is that digital capital, which is what Bitcoin is powering digital credit, and digital credit is 2 to 4 times more compelling than traditional credit instruments for people that want fixed income. How do I tokenize a currency? How do I raise capital with crypto tokens? What kind of decentralized or digital finance can I engage in? What are the rules of the road? And I think that's what we're expecting to have resolved in the Clarity Act. Our business model is to issue the credit. So we're selling public credit like STRC and STRD, STRF, and we've sold about $8 billion of that public credit. So we will issue billions, then tens of billions of dollars of public credit, and our Bitcoin is the collateral backing that credit. So that's our business. I think the formation of bank credit networks around Bitcoin is very auspicious. It's very good for the asset class. If banks would not give you a loan on real estate, your real estate values would be lower. And if banks were unwilling to give a loan on a stock portfolio, then that would impair a lot of people that want to invest in stocks. The banks are moving into offering credit on digital assets and especially on Bitcoin. That will be good for the banks. That will be good for Bitcoin. And it's merely an acknowledgement that there's $2 trillion of wealth that is unbanked right now. And this is the banks beginning to move into this new asset class and provide banking services to the $2 trillion of holders.
Final thought, what's your outlook for institutional adoption of crypto in 2026?
I think it will continue progressively. I think that there are very positive moves. There's good positive guidance from the banking regulators right now, directing banks to begin to support Bitcoin. There are really good moves from the banks. They've all announced they're going to begin to custody and hold Bitcoin. That helps. I think there's some positive guidance coming from Basel and the Basel working group that they will start to upgrade the collateral value of Bitcoin for bank balance sheets. That will be very helpful. So I think that all of those things will generally accelerate institutional adoption. Every single month that goes by, there are more large institutions that come out in favor of digital assets and Bitcoin in particular. And every single time one of them announces that catalyzes another to consider doing the same.
Michael Saylor's thesis is clear. Bitcoin is no longer defined by the halving, retail speculation, or cyclical narratives. The new era, beginning in 2025 and accelerating through 2026, is defined by bank adoption, regulatory alignment, corporate treasury strategy, digital credit markets, institutional liquidity, and infrastructure. Bitcoin is transforming from a volatile store of value into the digital base layer of global finance. And as billions and eventually trillions of dollars in credit, custody, and settlement migrate onto the Bitcoin network, the asset will not just appreciate, it will become indispensable.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.